Hello everyone, welcome to another episode of the Firm Returns podcast. Today we're going to have a look at a write-up I did on Aviva, which is a UK life insurance company. So let's have a look. So let's start with the company overview. First of all, I'll just mention when did I write this? This went out November 6th, 2022. So just to give you an idea of the date. I think this was the first one I put out on this new platform, which I'm using Ghost.io. Right, let's have a look. So Aviva is a UK headquartered insurance company with a history extending back over 3 centuries. It is listed on the main market of the London Stock Exchange and a member of the FTSE 100 index with a market capitalisation of circa £12 billion. Aviva's main business segments are UK and Ireland Life, UK and Ireland General Insurance, Canada General Insurance, and Aviva Investors. The figures used in the following breakdown of these business segments are taken from the latest annual report for the year ending 31st of December 2021. So we're going to go through a breakdown of the segments now. So it's just worth mentioning there that the business now operates mainly in 3 core markets, which are the UK, Ireland, and Canada. So those are the countries mentioned in those business segments there. Right, so the largest segment is UK and Ireland Life, which generated cash remittances of £1.22 billion in 2021 out of a total of £1.66 billion from continuing operations, or 73%. Aviva is the UK's largest life insurer with a 25% share of the UK market, equating to 11 million customers. Within UK and Ireland Life are the following product categories: savings and retirement. This includes workplace pensions, and we've got a few key facts here. So Aviva is the largest workplace pensions provider in the UK with 23,000 corporate clients and 4 million members. These pension schemes are largely sold through intermediaries. Also within this category are retail pensions. These are primarily sold through external advisory firms, but also internally by Aviva financial advisors. Then we have also within this UK and Ireland Life segment are the annuities and equity release, and this is broken down into bulk purchase annuities, individual annuities, and equity release. So with the bulk purchase annuities, currently Aviva is the second largest provider behind L&G, Legal and General, in the UK market, estimated to be worth £2 trillion, of which only 10% has been captured. So in the individual annuities market, Aviva is the largest UK provider with over 1 million customers. And in the equity release, it manages the UK's largest book of equity release mortgages, some of which have been securitized and sold on. So finally, the final sort of component within the UK and Life segment is protection and health. So individual, and this is further broken down into individual protection, which is what you traditionally think of as life insurance, group protection, and health insurance. So in the individual protection segment, we've got the second largest, Aviva being the second largest provider in the UK, and it's sold through intermediaries such as financial advisors and also directly to customers. In the group protection component, Aviva again is the second largest provider in the UK, and services include life cover, income protection, and critical illness cover. In the health insurance segment, we've got Aviva being the third largest UK provider with over 1 million policy holders. So Next, we're going to have a look at UK and Ireland general insurance. So UK and Ireland general insurance generated £261 million in cash remittances in 2021, or 15.7% of total remittances. So Aviva is the largest general insurer in the UK and third largest in Ireland, with a combined circa 6 million customers. The combined operating ratio core for the UK and Ireland general insurance was 94.3% in 2021, and in 2020 it was 98.2%. Its products can be divided into the following categories. So first up, we've got personal lines, which includes core offerings such as home, motor and travel insurance. It has multi-channel distribution, so it's sold directly to customers through the MyAviva portal, as well as listing on price comparison websites, PCWs, and through intermediary relationships with brokers and several UK banks. And in total, in personal lines, you've got 3.5 million customers. So something to mention here, actually, with the personal lines, I actually also have switched to using Aviva for a few different products. So I've used them for my home. I now use them as my home insurer. I now use them as my car insurer as well, and I've used them when I went abroad last year for travel insurance. And something that's nice is that with this MyAviva portal, you can buy all these sort of parallel offerings all directly through the same place where you have all the details for your current insurance. So, and on top of that, they give you a 10% discount if you are an existing customer already on one of their product lines. So there's real incentives to sort of stay with them, and the prices are still very competitive. Like, I mean, the reason I went for them initially with the home insurance was because they were the top two cheapest provider or something like that on a price comparison website, and the cheapest one did not look like a reputable brand at all. So competitive on price, but also has that reputation that draws you if you as well as being price conscious, if you actually care a little bit about the chances of being paid out, for instance. So in the commercial lines, so yeah, I mentioned that there's two categories. So there's the personal lines, and then there's also commercial lines. So this is going to be, so the personal lines is basically where they're dealing directly with the end customer, and commercial lines they're dealing more with businesses providing cover to like a whole portfolio of cars or something like that, or whatever other kind of stuff, on a sort of larger commercial scale. So the commercial lines business is divided between the SME business, small and medium enterprises, and the global corporate business, GCS, with both growing at double-digit rates in 2021. Right, so now we're going to move on to have a look at the Canada general insurance. So Aviva is the third largest property and casualty, which is the term used in Canada for general insurance, possibly America as well, provider in Canada, a market itself the 8th largest in the world, with estimated gross written premiums, GWP, of 69 billion Canadian dollars. Aviva holds an 8% market share. Cash remittances were £156 million in 2021, or 9.4% of total remittances. And its core combined operating ratio was 90.7% versus 2020's figure, which was 94.7%. So just the key point there is that that's actually a better combined ratio than the UK and Ireland general insurance, which was 94.3%. With Canada doing 90.7%. So again, divided into personal and commercial lines, and in the personal lines represented 63% of the overall business mix, and again these were predominantly sold through brokers and RBC Insurance. So they're trying to change this position of selling mainly through brokers and RBC Insurance by investing in their own digital sales channels like they have in the UK. to get that sort of direct to customer benefit and cross-selling opportunity they have in the UK already with their Aviva platform. So in the commercial lines, the SME business makes up 19.2% of the overall business mix. This is the overall business mix including the personal lines as well. And global corporate business, the GCS, makes up 18.1% of the overall business mix. And in 2021, growth across the commercial lines was circa 9.7%. So finally, we have Aviva Investors, which manages £268 billion of assets, with £216 billion of this being managed on behalf of the Aviva Group, and it generates cash remittances of £15 million in 2021 and profits before tax of £41 million. The products and customers it serves can be divided into the following categories. Well, just before I get onto that, I just want to make the point that the money they make, because they're largely serving the Aviva Group, they're not going to be really targeting. So like I said, 216 of the 268 billion pounds of assets that they manage have been managed on behalf of the Aviva Group. So that's not really, I imagine the profits on a lot of that stuff is going to go down to the life insurance business or the general insurance business and so on, rather than being attributable to the Aviva Investors segment. So crucial, really, all of the revenues, the actual cash remittances they're going to generate here are going to be coming from the smaller portion that is managing external assets directly for, so perhaps for other, well, we'll get on to the external clients. So yeah, let's have a look at the products and customers it serves. And principally, we've got the as I've mentioned, the Aviva client distribution channels and the external client distribution channels. So in the Aviva client distribution channels, we have the savings and retirement. So it offers products to Aviva's defined defined contribution, pension and saving customers. So these are the customers that are paying a fixed amount and they each month or whatever, but they're not getting as opposed to the defined benefit schemes, which is more where the bulk purchase annuity business comes in, with Aviva buying the pension liabilities from companies that provide their employees, or have in the past provided their employees, with defined benefit pensions, where they're saying we're going to give you this set amount, fixed percentage of your salary, maybe inflation adjusted, once you retire. So in the other client distribution channel is going to be the Aviva shareholders. So this is where it's providing investment solutions for the bulk purchase annuity and individual annuity funds. So in these cases, they're not providing, the clients aren't directly getting. This is the reason why the shareholders are considered the clients here, is because the actual holders of the annuities are going to be, or the recipients of the annuities rather, have provided funds to Aviva, and the way Aviva is making money is by investing those funds and generating a larger return than they, in aggregate across all of the annuity portfolio, than they are paying out in annuities. So that's where the Aviva Investors comes in for the managing of that and making sure that sufficient margin is made for it to be profitable. So in the external client distribution channels, we've got the large asset owners. So these are sort of insurance companies, consultants, pension funds, sovereign wealth funds. And then we've also got global financial institutions, which are the large private banks, and we've got UK wholesale intermediaries to retail customers, so e.g. independent financial advisors and wealth managers. So I think Aviva has become quite a leader in some sort of environmental and sustainable sort of investment products. So I think there's cases of them offering these products to some other larger funds and so on that want to access these products but don't have their own offering at the moment. So that's something that they're providing with these sort of to these external clients, this in particular. So something to note is that cash remittances from subsidiaries cancel out on consolidation and hence are not directly reconcilable to the group's IFRS, a consolidated statement of cash flows. In effect, this means that cash payments might be paid to the parent company even if the group as a whole has had net cash outflows from operations. This was the case in both 2021 and 2020, where the cash flows from operations were both negative. So we'll talk quite a bit about this later on when we address the cash flows properly, because this is a bit of an illusion, that effect that you're seeing in the IFRS financial statements. So Aviva had a number of other international subsidiaries which divested in 2020 and 2021 for total proceeds of £7.5 billion. The case for this divestment was to focus the company on its core markets where it holds substantial market share and is most profitable. £1.9 billion of the proceeds was used to repay debts, bringing the debt leverage ratio down to 27%. A further £4.75 billion was returned to shareholders through a £1 billion share buyback programme and a £3.75 billion direct cash payment in order to maintain the share price. In order to maintain the share price, a share consolidation was undertaken, reducing the share count by 25%. So yeah, they basically gave back a quarter of the company in terms of cash repayments and the share buyback. So because the company I think the book value of the company is about £20 billion, and it's now about £15 billion. So they gave back just shy of £5 billion of that. So that basically meant that they just reduced the share count by 25% to mean that the share price sort of held up and didn't tank. So let's have a look. The management aims to maintain centre liquidity of circa £1.5 billion in normal circumstances. This represents a year's worth of centre costs, debt interest and dividend payments. Excess liquidity beyond this is available for investment or return to shareholders through dividends and share buybacks. As an insurance company, Aviva is subject to the Solvency II regulations. These include the Solvency Capital Requirement, SCR, which is the amount of capital Aviva is required to hold on its balance sheet to cover its insurance liabilities in a 1 in 200 year catastrophic event. This figure is influenced by both the size of the insurance liabilities and the current level of interest rates, i.e. expected return on assets. As of 31st of December 2021, the SCR Solvency Capital Requirement stood at £9.1 billion, a decrease of £3.7 billion on the previous year, reflecting the business divestments and an increase in interest rates. Another important metric is the shareholder coverage ratio, which is calculated by dividing the shareholders' equity by the SCR value. Also, helpfully, shareholder coverage ratio also could be turned into an acronym of SCR, which is a bit confusing. But yeah, SCR is Solvency Capital Requirement, and it's used in the calculation of the shareholder coverage ratio. The management of Aviva has stated that they aim to target a shareholder coverage ratio of 180%, and any capital above this will be available for investment or return to shareholders. Let's have a quick drink. Yeah, so something crucial actually to say with that, I mentioned there the shareholder cover ratio, anything above 180%, they're looking to, they've already shown a willingness, and they are, with the previous shareholder returns of capital, like the 4.75 billion combining share buybacks and dividends they made before. But they're also looking to potentially do additional share buyback programs or whatever, depending on whether the stock is depressed, and that makes sense compared to paying dividends if it goes above the 180% shareholder coverage ratio, and it has been for since this period end. I think it was something like 220% or something like that in their last reported results. So there's quite a bit of room there for more capital returns. All right, so let's have a look. So Aviva is making the following investments over the next couple of years: circa £100 million per annum between 2022 and 2024 in internal growth investments, expected to boost operating profits by £100 million from 2025 onwards. £200 million invested in cost savings, expected to yield £250 million per annum cost savings from 2024 onwards. And then acquisitions, including the now completed purchase of Succession Wealth, a UK-based wealth management and financial advice firm, for £385 million. This acquisition is expected to yield a double-digit return in the medium term, as the financial advice services are offered to Aviva's 6 million pension and savings customers in the UK. So some potential synergies there. The company has announced its intention to pay dividends of £870 million and £915 million in 2022 and 2023 respectively. This equates to 31.5p and 33p per 31.5 pence and 33 pence per share, and reverses the dividend cut that occurred during the pandemic. Subsequent mid-single-digit dividend growth is expected from 2024 onwards, in line with growth in profits/cash flows. So yeah, I think they're still standing by that guidance. We're going to have the payment of the final. We're still waiting for the payment of the full year dividend for 2022, obviously, but that's normally paid in the following year. But yeah, everything is still following by the guidance they set out there. So let's have a look at some figures from the balance sheet. So in the consolidated statement of financial position from the 2021 annual report, total assets were listed as 358 billion 474 million. Sorry, I've got it written here in thousands of millions, so it makes it a bit complicated to read out. But 358 billion 474 million, set against total liabilities of 339 billion and 20 million pounds, leaving total equity of 19 billion 454 million. So as previously mentioned, a substantial chunk of this equity has since been returned to shareholders, which is why it's now probably around about 15 billion. So the largest items on the asset side of the balance sheet were financial investments of 264 billion 961 million, loans of 38 billion 624 million, and reinsurance assets of 15 billion 32 million. So yeah, you can have a look at the report that I've written here on my website, firmreturns.com, and I'll include it in the video description to actually read all these figures. I appreciate it's hard to follow them, just listen to them. But so current assets total 26 billion 624 million, of which 12 billion 485 million were cash and cash equivalents. So that will have been reduced quite a bit after the repayment of that capital. So on the liability side, the two largest items were gross insurance liabilities of 122 billion 250 million and gross liabilities for investment contracts of 172 billion 452 million. Current liabilities totaled 22 billion 945 million, so comfortably under the current assets there. So we've got a nice current ratio in excess of 1. So overall, the assets and liabilities seem to be well matched by duration, with sufficient liquidity to cover near-term liabilities. Let's look briefly at the income. So after tax, the profit for continuing operations was £336 million. In 2020, this was £1,466 million. Adding the profit for the year from discontinued operations and the profit made on their disposal gave a profit for the year figure of £2 billion and 36 million. That sounds a bit weird. 2.036 billion pounds, and in 2020 it was 2.91 billion pounds. So come down a bit. We're also given an adjusted operating profit figure which strips out short-term fluctuations due to changes in economic assumptions. The group adjusted operating profit before tax from continuing operations was 1.634 billion compared to 1.806 billion pounds for 2020. So the variance between these two figures can be seen to be much smaller than the net profit from continuing operations. So next we have a look at the cash flows, and I've given here a table of showing the cash flows for the last 15 years from 2007 to 2021. And I won't read all of them out, but you can have a look at them in the article. And but I'll just read out what I've written here. So cash flows for 2020 and 2021 have been skewed by the investment of the proceeds from the disposal of discontinued operations, which was £7.5 billion, into financial investments. For accounting purposes, this is treated as a net payment to the operating businesses, causing the cash flow from operations to appear substantially negative. As you'll see later on, this had the reverse effect in H1 2022, as these funds were disinvested prior to the return of capital to shareholders, serving to positively boost the cash flow from operations. So that's quite a crucial point, the fact that because they sold off all these businesses and then gave this money to, I guess, the Aviva investors, which is one of their operation subsidiaries, to manage and invest for them temporarily into treasuries or whatever kind of fairly liquid assets somewhere to hold the money. That was counted as a net payment to their operations, which made it look like their cash flow from operations were very negative in 2020 and 2021, in the 2 years that they were selling off these assets, these business segments. And then when they had to take that money back out, and so Aviva investors then paid the parent company the money which was then given to shareholders, that was counted as a positive cash flow from operations, a very substantial one, of reversing that the 2 years worth of stuff in one 6 month period. So that skewed it the other way. So it just shows you that sometimes looking at these figures in this way and not really delving into the notes of them can be quite misleading. So you really do need to read the small print and look at this. Was just like a little footnote underneath the cash flow statement, and it was only actually on the interim report that they really detailed this. I was scratching my head trying to work out why they were so negative from the annual report, the 2021 annual report, but it just, obviously somebody else had the same point and probably flagged it up with the management, and they'd actually helpfully put a little footnote in saying this is why it had occurred. So, and I think later on I actually include a quote of that footnote, so yeah, we'll have a look at that, but I think it's just worth mentioning that at this stage. So if you do look at this table, you see the last couple were quite negative, which compares a massive swing compared to the sort of £6.5 billion of cash flow from operations achieved in 2019, for instance. Right, so let's continue here. So as can be seen, the cash flows vary quite considerably from year to year, but the average over this period was £3.351 billion. If you exclude the last 2 years, that could be considered to be exceptional, the average figure is £4.227 billion. While the recent divestments could be expected to result in lower cash flows from operations in the near term, the average figure for the last 15 years may still be representative of expected cash flows moving forwards. This is because the business has made both acquisitions and divestments throughout the last 15 years, and so has varied in size over this period. The remaining operations also represent the core of the business and the principal profit centre. To get a better picture of the cash flows attributable to shareholders, it is instructive to subtract financing costs such as interest expense and tax from the operating cash flows. This leaves us with the following free cash flows. So yeah, I've done another table here which gives you a further breakdown of these calculated free cash flows figures. So from this calculation of free cash flow, we get the total free cash flow for the last 15 years was 28,509,000,000, so substantially more than the current market cap has been returned in the last 15 years, and the average for a single year was 1.901 billion. Excluding the last 2 years brings these figures to which have been quite skewed because of what I was saying, brings these figures to 35.64 billion and 2.74 billion respectively. So that's a massive, jump if you take away just the last couple of years, which together were a negative sort of cash flow combined of over 7 billion, because of the, like I was saying, the skewing effect. So let's just have a look. So I've given here a brief note on the H1 2022 results. So this is going to break down and go through the interim results here. So for the first half of 2022. So group adjusted operating profit was £829 million, an improvement on H1 2021, where the comparative operating profits from continuing operations were £725 million. However, an overall loss was reported for the period of £633 million. This disparity came substantially from short-term fluctuations in the return on investment for non-life business of £1.08 billion and investment variances and economic assumption changes for the life business of £537 million. While this loss does not reflect the underlying profitability of the business operations or the cash flows they generate, it does reduce the equity attributable to shareholders. So yeah, it's largely fluctuations in the variances in the assets and valuations, and these are not actually cash flow changes. So as of 30th of June 2022, total equity came to £14.401 billion, down from £19.454 billion at 31st of December 2021, principally due to the return of capital to shareholders during this period. Of this total, £252 million belongs to non-controlling interests and £496 million is attributable to the owners of the 6.875% fixed rate reset perpetual restricted Tier 1 contingent convertible notes. Oh, that's quite a mouthful, that one. Issued during the period. These notes convert to ordinary shares on the occurrence of a trigger event, which relates to own funds falling below the SCR by a given amount or for a certain period of time. While these notes are in all other respects no different to the rest of the company's subordinated debt, their convertibility means they are treated as equity. So yeah, that's just a little note for those notes that were issued there. So being convertible on if the SCR went below 100%, which is, considering it's up over 200%, is pretty unlikely. So SCR decreased from £9.1 billion to £7.7 billion between 31st of December 2021 and 30th of June 2022. This coincided with a reduction in own funds from £22.2 billion to £19 billion. So own funds includes the debt as well, meaning the shareholder coverage ratio, or rather, it includes the debt because that's effectively the capital that's owed to external entities, not the shareholders of the business. But that is included when it comes to insurance liabilities. The debt holders still stand to lose before the insurance policyholders. So this decrease meant that the shareholder coverage ratio dropped from 244% to 234%. There is expected to be a further reduction in own funds of £1.6 billion when accounting for planned debt repayment and the acquisition of Succession Wealth. This would bring the shareholder coverage ratio down to 213%. So still substantially above their target, as I say here. So this is still significantly above the 180% target, leaving room for further investment and return of capital to shareholders. The board has stated that they anticipate commencing a new share buyback program in 2023 following the publication of the 2022 full-year results. Cash flows from operating activities before tax were £6.148 billion compared to £517 million for H1 2021 and negative £2.554 billion for financial year 2021. So this dramatic difference is helpfully explained in a footnote, which also goes some way to explaining why 2021 and 2020 both had negative cash flows from operations. So this is what I was referencing before. So it reads as follows. Cash flows from operating activities in the 12-month period ended 31st of December 2021 and in the 6-month period ended 30th of June 2022 include impacts from the investment of proceeds from the disposal of discontinued operations into financial investments during 2021 and subsequent disinvestment from those financial investments in the 6-month period ended 30th of June 2022 ahead of the return of capital to ordinary shareholders. This activity is reflected as an increase in cash generated from operating activities in the 6-month period ended 30th of June 2022 and in 2021 a reduction. So as mentioned before, the operating cash flows were substantially reduced on paper by the investment of the disposal proceeds and then boosted by their subsequent disinvestment. Cash remittances from operations for the period were £798 million. This is down from the same period the previous year, which had H1 2021 had £1.052 billion, primarily due to cash being held in operations in 2020 during the uncertainty around COVID and then released in 2021. So just got a little 2021 got a boost there because some extra cash was held in the operations just in case payouts or whatever were needed. So centre liquidity reduced to £2.735 billion following the capital return and share buyback and loss for the period. Finally, IFRS net asset value (NAV) was 480 pence per share as of 30th of June, or £4.80 per share as of 30th of June 2022. This is calculated by dividing the equity attributable to shareholders of £13.653 billion, which is when you subtract that £252 million owed to the other non-controlling entities, by the number of ordinary shares outstanding. And sorry, there's another 496 attributable to that, the owners of that fixed rate convertible bonds. So let's have a look. Yeah, so divide that 13.653 billion pounds figure by 2.8 billion pounds, which is the number of shares outstanding. So yeah, that gives you the £4.80 per share for NAV. So just to give you some context, the share price now is £4.40, so it's closed up quite a bit. I think when I wrote this, it was like £3.75, £3.80, something like that. So it's closed up a bit, but still, it's yeah. We'll get onto valuation and stuff later, but as a multiple of free cash flow that they've been able to achieve over that period. I mean, when you factor in we'll get onto that later. But anyway, so let's just have a quick look at management. So, before that, I'm just gonna have a quick drink. So, management. The few years prior to 2020 were quite turbulent for management, with a number of executive changes after relatively short tenures. Since mid-2020, the situation has stabilised somewhat, with the exception of the departure of Jason Windsor, the CFO since 26th of September 2019, in July 2022. Charlotte Jones, the previous CFO of RSA Insurance plc, is being brought in to replace Jason with effect from 5th of September 2022. The current CEO, Amanda Blanc, was appointed to the board as a non-executive director on 2nd of Jan 2020 and then CEO on 6th of July 2020. Amanda has spent much of her career working in the insurance industry. She started as a graduate at one of Aviva's legacy companies, Commercial Union plc, and has since progressed through a variety of roles, including a number of senior executive positions at companies such as AXA and Zurich Insurance Group. George Colmer, the current chair of the board, was appointed to the board as a non-executive director on 25th of September 2019 and became chair on 27th of May 2020. George has a wealth of experience gained from holding senior executive positions at a number of banking and insurance companies, including Lloyds Banking Group plc, RSA Insurance Group plc, and Zurich Financial Services. So quite a few people from RSA Insurance in prior careers. So I think the board and executive team have done a good job of steering the company through the pandemic while simultaneously carrying out significant divestments. They have also made significant capital management decisions that have been well aligned to the interests of shareholders. This has included the return of £4.75 billion of capital to shareholders from the proceeds of business disposals through share buybacks and direct cash distributions. It's also worth noting that there may have been some influence from activist investors on the size of the return of capital. Sevian Capital, which built up a stake of 5% in 2021, was an outspoken proponent for a return of capital following the business disposals. Yeah, so there perhaps was an impact there, but it's largely I've owned the company since 2020 now, and I've been held it through all of this period of divestment, and at every turn I've liked the stance of Amanda Blanc and the other management going through it. It's something, I mean, this is not really to do with the investment, but something that's quite unfortunate was there was the AGM, I believe it was the 2022 AGM, so last year. It was quite unfortunate. Some of the male fund managers and big wigs in the city of London decided to crack a few female related jokes at Amanda Blanc, like looking for somebody to be wearing the trousers and all that kind of like standard derogatory stuff. Unfortunately, just not the kind of stuff you expect to hear at any kind of an AGM like that. You thought we'd progressed with our times, but apparently not. So, I mean, George Colmer, the chairman of the board, was really quite furious, and you could tell that. But just generally, yeah, it's quite sad to see that kind of reaction to to a female CEO, I believe is doing a really good job here. And I mean, that aside, she doesn't deserve that kind of treatment. But in this case in particular, I mean, I think she's doing a much better job than her male predecessor, and a string of them before that. So yeah, just a sad little tangent there to hear that kind of thing is happening in this day and age still. So let's have a look at. But yeah, like I say, it's nice to see that they're shoring up the board with CFO being a woman as well. So it's nice to see that. Anyway, so valuation and investment case. There are two main ways I would approach valuing Aviva. The first is by looking at its book value, or equity attributable to ordinary shareholders. As of 30th of June 2022, this stood at 13.653 billion pounds, or £4.80 per share. This theoretically represents the cash shareholders would receive were the business to be liquidated. While this gives you some idea of your downside protection, it is subject to short-term fluctuations in the value of assets and liabilities, as we saw with the £633 million loss for H1 2022. It also doesn't reflect the value generated by the business operations. For this, I think cash flows offer a better avenue for valuation. So something I will say here is when I first bought the company, it was trading at something like 0.6 times book value, maybe 0.5. I bought it for £2. The cheapest price I bought it was £2.65 a share, right at the key time when they cut the dividend, and it was all all the uncertainty of the pandemic. They didn't know what the insurance claims were going to be and all that kind of stuff. I just thought, if the dividend does come, when I looked at it, I thought if the dividend does come back, then it's the yield on the dividend is going to be like, I think at that point it was close to 15% or something crazy like that at the share price. So, well, maybe like 12% or something. It just was a crazy valuation. So I just thought there's plenty of margin of safety there, just on the book value basis. And I think I continued buying it up to at that early position. I also I bought some up and around about the £3 mark, but I've since bought it. I've since added to my position around about the time they were doing the divestment. So around about the £3.75 to £4 a share sort of price range, and possibly even some at £4, around about the current price of £4.20 to £4.40. But yeah, we'll get on to, I potentially believe there's still quite a bit of upside from here, but perhaps not as much as there was when I bought it at sort of below £3 a share. But anyway, let's have a look at the. So as I said, so for this, I think cash flows offer a better avenue for valuation. So cash remittances are important as they represent the funds available for paying dividends and reinvesting in the business. However, like profits, they are somewhat arbitrary as they depend on management decisions around reserve requirements, as we saw from the artificial boost in 2021, as reserves held in 2020 were released. This is a common thing you get, and you get it in banking as well, when they hold back like loan provisions and stuff like that for all their expected losses they're going to be getting in the next period, because they think it's going to be a downturn or whatever, and that means they don't end up having to perhaps pay as much tax as they would have done if they'd. I mean, it's prudence as well. Obviously, they've got these loan provisions and stuff, or in this case, holding money back for insurance claims and stuff. It's a prudent thing to do, but it does mean they sort of defer their taxes to a later period when they then do release that money. So it's a bit of a accounting trick, I think a lot of financial institutions play, but also arguably an element of prudence in there. So it's hard to pin them down on it, but it does cloud the picture anyway of what the actual underlying business is doing. So for a better picture of cash generated / used by the business operations, we need to look at cash flows from operations, which, after taking into account financing costs and taxes, gives us the cash flows available to shareholders. As we've seen in the figures from 2020, 2021 and H1 2022, The cash flows from operations can vary considerably from year to year and be skewed by exceptional items such as business disposals. Therefore, it serves us to average this figure over an extended period, as I did above, with data going back to 2007. From this analysis, I arrived at an average figure of £1.901 million, including 2020 and 2021, and £2.744 billion when excluding these years. Given that 2022 is likely to be reversely skewed to 2020 and 2021, and thus cancel out their negative impact, it seems reasonable to say the average should be a little higher. However, to be prudent and to make it a nice round number, let's say the business is generating cash flows for shareholders of circa £2 billion per year. With shareholder equity of £13.65 billion, this cash flow represents a return on equity of circa 14.6%, or with the current market cap of circa £2 billion, a free cash flow yield of circa 16.7%. This yield provides a considerable margin of safety against negative events, and given the management's positive stance on returning excess capital to shareholders, plenty of scope for increased earnings / dividends per share and a capital appreciation from share buybacks. There is also plenty of room for organic business growth through reinvestment and inorganic business growth through targeted acquisitions like that of Succession Wealth. So we shouldn't only expect this cash flow figure to remain static or decline. So on the topic of sort of acquisitions there, something I do like about Amanda Blanc, and I think the strategy that she's put in place of divesting all these non-core assets and so on, is that it's a much more disciplined and focused approach, and it really, and something that perhaps a lot of male CEOs in particular fall victim to, is this: they fall prey to the idea of empire building, and we've seen quite a lot of financial companies in the UK fall to this, like all of the big banks, Lloyds, Royal Bank of Scotland, and all sorts, Nat, which now is sort of NatWest, and Halifax, all these kind of big banks that got way over their skis and expanded out. And I think RBS at one point was the world's biggest bank in terms of assets, just absolutely crazy numbers, and it just was not sustainable at all. And when we had the financial crisis, it all came crumbling down. And I mean, this just really was a case of this kind of thing is a risk that comes from having CEOs with big egos and doing a lot of empire building. So it is nice to see Amanda Blanc being, as far as I can tell, a very much a low ego type of CEO, prudent, conservative with her approach, but equally and really focusing on returns to shareholders, not focusing on how big can I grow the business and how big can I make my compensation package. So yeah, it's definitely something I've learned to factor in when you're thinking about. Well, it's definitely a crucial component when looking at management and a business sort of generally. So I just give a rundown here of the risks as I see them. Oh, it's quite a bit, but let's just have a look. Let's run through these quickly. So, as an insurer, Aviva is in the business of assuming and managing risk on behalf of their customers. Each business segment is exposed to its own set of risks, some of which are common across the company, and others that are specific to that business segment. This provides some diversification within the group's overall risk exposure. Life insurance, which is the largest business segment, is exposed to two principal specific risks: longevity risk and mortality risk. The former affects the annuity business, as it means customers are living longer than expected and so receiving payments for longer than originally accounted. While this risk has a big impact on the business, longevity is closely monitored and tends not to change significantly in the short term. Mortality risk is the opposite of longevity risk and affects the life protection business. Any increase in mortality and subsequent increase in life protection payouts would at least partially be offset by gains from the annuity business, assuming there was some crossover between the demographic groups for each product. So yeah, a real benefit of providing businesses that gain in two different directions. One gains from people living longer, one gains from people living shorter. So general insurance similarly has its own specific risks. These relate primarily to loss events, fire, flooding, etc., and inflation. The former adds an element of cyclicality to Aviva's profits, as there may be spikes in the number of events in some years and then quiet periods in others. The key to mitigating this risk is to hold sufficient capital to cover extreme periods with increased loss events. Capital requirements are specified by regulators, and Aviva has a substantial surplus above these required levels. If loss events appear to be occurring with increasing frequency, premiums can be adjusted accordingly. This is a benefit of policies typically renewing on an annual basis. Yeah, so this is a bit of a difference between sort of life insurance, which often is you get an annuity locked in, and that's then for a much longer period, or these kind of long-term things that you're not getting increases. It's not renewing every year. You're not getting extra premiums coming in every year. And then the general insurance, which as long as you can keep on top of the costs in 1 year, you can then recoup some and raise the premiums the next year to recoup some of those costs that have increased without too much impact. So the maximum would be a year effectively of incurring a higher cost before you can start to charge it. So I think I mentioned a bit in the next one. So inflation risk comes from periods where the price of fulfilling a claim, repairing a car, house, etc. rises rapidly, possibly to the point that the aggregate cost of the claims exceeds the initial premiums. This is something that can again be mitigated by holding sufficient liquid capital. Ultimately, the premium prices will be adjusted to reflect these increased costs, but there may be a lag period where losses are incurred. This will be limited to the relatively short duration of general insurance policies. As I was saying, health insurance is exposed to morbidity risk and medical expense inflation. Morbidity relates to the proportion of customers falling sick, and is generally mitigated by close monitoring of disease frequencies amongst the population and carefully worded policies. Medical expense inflation carries the same risks and warrants the same mitigation strategies as general insurance expense inflation. Risk common to all business segments and the group at large include credit risk, liquidity risk, market risk, operational risk, and conduct risk. So we'll have a look through some of these in a sec. Let's go and have another drink. So Aviva is exposed to credit risk on its portfolio of corporate bonds and other debt instruments. Defaults above a certain level would jeopardize the company's ability to cover its liabilities and thus the solvency of the business. The company mitigates this risk primarily through diversification, which limits its exposure to any one company or industry. It also weights the majority of its debt holdings towards investment-grade securities, further decreasing the risk of loss. As touched on in the segment-specific risks, the company protects itself from liquidity risk by ensuring it has sufficient capital in the form of cash and liquid assets to meet expenses under extreme conditions. This is an area that is heavily regulated, and so there is little scope for imprudence on the part of management. As the majority of the company's assets are publicly listed, they are exposed to the fluctuations of the market. These fluctuations constitute the company's market risk and can affect its ability to cover its liabilities as they become due. Some of these fluctuations in asset values are offset by similar movements in the value of liabilities. This is the case, for example, with investment contract liabilities that don't have guaranteed returns. Where a decrease in asset values has been caused by a rise in interest rates, this also has the positive effect of decreasing the value of long-term insurance liabilities. the present value of which is calculated using a discount rate based on the market rate. There is also the potential for asset values to be adversely affected beyond the extent of offsetting movements in the value of liabilities. To manage this risk, the company endeavours to match the duration of fixed assets with their corresponding liabilities, thus removing the need to sell the assets before they mature. In addition, the company also employs hedging strategies aimed at further reducing exposure to market risks. To similar effect, the company makes use of reinsurance to remove certain liabilities from its balance sheet. Reinsurance also helps to protect against other risks mentioned, and is used where the company does not see sufficient reward for the risk it is taking onto its balance sheet. While I'm discussing risk, it is worth mentioning some of the recent events we've seen in the UK gilt market and subsequent effects this had on the UK pension industry. Markets took flight after the publication in September of a fiscal statement by the UK government that was deemed to contain spending commitments that would require unsustainable levels of additional borrowing. I won't dwell on the fiscal statement itself or the political fallout, but the economic effect was to cause a drop in the value of the pound and a sharp rise in the yield of government debt, which I benefited from by buying some gilts when they were depressed. It was this sharp rise in gilts and corresponding fall in gilt prices that triggered a crisis in the UK pension industry. The decreasing interest rates of the last few decades left many pension funds unable to meet their liabilities with the reduced yield available on fixed assets. Some addressed this deficit by moving a portion of their funds into higher yielding but higher risk assets such as stocks, lower grade debt, and other alternative assets such as real estate and infrastructure. Many more stuck with government and investment grade corporate bonds, but applied leverage through LDIs and other instruments to synthetically boost their yield. When the price of UK gilts, which were being used as collateral, fell sharply, the pension funds received margin calls and became forced sellers of the same gilts as they struggled to find sufficient cash to cover their positions. Ultimately, the Bank of England stepped in and started buying these bonds on the market, stabilising their price and preventing a downward spiral taking hold. Had it not done so, a large number of UK pension funds would have become insolvent, with many British people losing some or all of their pension. Aviva uses derivatives to protect against movements in foreign exchange, interest rates, and the value of equities. Let me just have a look. Yeah. So just a key point with that pension stuff is it's largely affecting the individual corporate schemes, which are all signed up to these things, and I think insurers like the big insurers like life insurers like Aviva and Legal & General were fairly protected against this thing and didn't really recognise any major effects from it. So yeah, they were well covered on that front. It was largely the smaller. Well, I think something like 90% of companies in the UK have the individual corporate schemes or something like that, defined benefit schemes and so on their books, which suddenly were suffering from this. But actually, I don't know about Aviva, but I know Legal & General actually sells some of these leveraged instruments so Legal & General, even though it's a life insurer, has quite a lot more of a financial services arm, selling these kind of leveraged instruments and so on, and they manage, I think, over £1 trillion worth of assets compared to Aviva's 268 billion or whatever. So it's quite a bigger sort of asset management business with Legal & General. But yeah, one of the products they provide is this, and they didn't actually have any risk themselves, but effectively they were having to work with some of their clients to try and prevent them getting into trouble, because I think they then actually pass on they're effectively a broker for it. I think they're setting up these deals with, so they're not even there holding the bag and being the one liable if the pension funds become insolvent or anything. That would be the people they connected them up, the actual lenders they connected them up with. But yeah, just an interesting sort of side tangent there. So anyway, let's go back to it. So Aviva uses derivatives to protect against movements in foreign exchange, interest rates, and the value of equities. They recognise derivative assets of £5.734 billion and derivative liabilities of £5.763 billion in the financial statements for the year ending 31st of December 2021. The net liability from derivatives is lower than this, circa £1 billion, after accounting for collateral pledged. You can see from this that the company has balanced its derivative assets and derivative liabilities, so the net exposure is minimal. As noted above, the group has substantial liquid capital which should be sufficient to cover any increases in collateral requirements. So even if they did have some problems because of sudden spikes in the yield on bonds that they were using as collateral, so therefore the actual price of the bonds going down, and then you got your margin calls there, they still have, being a sort of life insurer that has to have a substantial amount of liquidity and capital. They had plenty of, you would expect they have plenty of liquid capital to cover it. So with a lot of the other with all these individual company pension schemes and stuff like that, they don't have to have this kind of margin coverage ratio of sort of 200% or whatever that Aviva has. As these big life insurers have, they only barely need to just be into a surplus effectively of their pension schemes. That's pretty much the only requirement, and otherwise it's just any deficits are the responsibility of the company, the parent company, to pay with these sort of corporate schemes, so attributable to the shareholders of that corporation. So let's have a look. So as a large life insurer, Aviva has the resources to manage these risks where smaller corporate pension managers may not. This recent market volatility could provide a tailwind for Aviva's bulk purchase annuity business, as companies look to remove pension liabilities from their balance sheets and therefore prove to be a net benefit to Aviva. So yeah, I mean, that's another good point, is that with this kind of turbulence and these corporate pension schemes realizing, oh shit, we were exposed to these big fluctuations and it nearly tanked us, it nearly sank us. We're maybe they're now, a lot of them, because the interest rates are going up, they're now in a pension, they have surpluses on their pension schemes because the value of the liabilities has dropped more than the value of the assets they're holding in most cases. They're now all sitting on a surplus where they haven't had that for years because interest rates have been so low. They've been falling into deficits on all these defined benefit pension schemes. So now they're in this position where they actually have a surplus. Now's the time for them to sell them to large insurers like Aviva and Legal and General and so on, that can bulk purchase their annuities, which is effectively what the defined benefit is. It's effectively an annuity. It's a bulk purchasing these, and taking the risk off the books of these corporations. Obviously, they have to give up some of their surplus, and that's where the payment comes from. That's where Aviva earns the money. They get some of that surplus, but the company doesn't have to worry about it turning into a deficit in the future and having to cover it. So yeah, I mean, I'll just give you the conclusion here, and then which I've written. So in conclusion, Aviva trades at a discount to its book value and an attractive multiple of its average cash flows for the last 15 years. It is well equipped to withstand short-term market volatility, which has produced paper losses that belie the continued strong performance of its business operations. This creates an opportunity for investors willing to look through negative sentiment and purchase a market-leading company at a discount price. So yeah, I mean, where am I with this investment? So yeah, it's for me, I'm using it. So my general sort of requirement for anything I'm investing in is I want to see the potential for 15% an IRR of sort of 15%. I want to be getting sort of 15% a year from it going forward. That's my cost of capital discount rate. So Aviva, with their free cash flow, I think it was like free cash flow yield on the current price, which is now, like I say, it's gone up a bit since then, but it's still around about the 15% mark, 15 to 16%. So it's nice, just fits into my sort of minimum requirement there, and that's obviously not factoring in any kind of growth going forward. That's just on their current valuation. So I give them perhaps a bit of leeway as well, because I mean as we've seen, they pay a lot out. They have a willingness to pay a lot out to shareholders, but generally I'm kind of seeing it as the company's been around for almost 300 years, so it's a very enduring business in the life insurance and sort of general insurance, especially when you get to this kind of size with this kind of experience, and it's something I'm seeing as a bit of a backbone to my portfolio. I'm not expecting sort of stellar returns from it. I mean, I've already got really good returns because I bought it at a crazily depressed price of sort of below £3 a share, but it's sort of almost 50% of its book value. But I'm not expecting those kind of stellar returns going forwards, but I just see it as a good sort of stalwart backbone to my portfolio to hold it sort of steady and give me a good dividend and pay me, and still pay, over the long run I'm expecting 15%. I mean, this company, a company of this quality in the FTSE 100, trading for below 10, below a P of 10 seems to be quite undervalued. So, I mean, there is probably still some upside, but I'm not expecting it to sort of double from here or anything like that. But I expect it to do well over time. I expect to get a good sort of average annual return from it. So, I mean, yeah, it's one I'm happy to hold. I mean, we'll see where the price goes. If it went up to sort of £600-700 or £6-7 a share or something, then maybe I'd start thinking, well, maybe I could put this I could find somewhere else fairly solid to put this money. But yeah, I still like the business. I like the management. I think it's something I'm happy to hold for now, and I'm not looking to sort of sell it and put it into something else that's potentially a better opportunity. This is like I'll do that. I mean, everything else in my portfolio, I'm looking to it to be as high. I want to see really good return potentials and much larger sort of short-term returns, perhaps. Like I've got companies in there, Warner Brothers Discovery potentially, Somero potentially is a fast grower, Taylor Maritime, they're either trading at a really massive discount to sort of like their what I could say they're easily they're short term. You could get a short term boost from them. Maybe you could see a double in just a few years with those kind of stocks, or certainly outsized returns anyway, above my 15% in the short term. And those are sort of like what I'm looking for generally, but it's nice to just have these kind of cheaply valued quality stalwarts in there as well to give you that sort of backbone. And it's they're still cheap, they're still giving me the 15% a year. Don't get me wrong, I'm not looking to buy a Unilever or something that's going to pay me, I'm going to pay 20 times or 30 times or whatever it is now. That's not what I'm looking for here. But yeah, I think Aviva is like that nice kind of middle ground, still cheap, giving me a potential for 15% or more a year in returns, but yeah, there's not crazily discounted at the current price. It's not like that crazy potential for a boost in the short term. It's not going to double, for instance, in the next year or two, like some of the others are. But anyway, yeah, that's pretty much it for Aviva. I mean, this is a company, like I say, a really solid one I really like, and I think it's one that's going to be, it's been around for 300 years. It could comfortably be around for another century beyond here. I don't think the life insurance business is something that's going to disappear as long as humans don't become immortal. But even then, you've still got the potential for you still have all these factors to consider in the general insurance segment and so on. And it's a business that's adapted, and I think they're going to maybe pivot more. They've got this opportunity now with the bulk purchase annuity Legal and General is already a market leader in that. Has been that they make most of their income from that now, I think. So I think I could see Aviva expanding out into that, pulling up, getting some more of that trade. But yeah, it's much more diversified than some of the other players out there. Obviously, still a lot of life insurance, but I mean, it's not crucially in just like one segment of life insurance. Like Legal and General, for instance, is very concentrated in the bulk purchase annuity, but Aviva's much more in the individual annuity and so on. But yeah, it's a solid business. I really like it. And yeah, it's got a nice slot in my portfolio. But yeah, if you want to read this report, like I say, I'll put the link below in the show notes. But you've also got, if you just want to have a look on the firmreturns.com website, you can find it all on there. And and I mean, follow me on Twitter as well for future release and so on. Subscribe to the newsletter. It's to the firmreturns.com. You can subscribe there to the newsletter and get these kind of things straight in your inbox. Thanks a lot for listening, everyone. I'll see you in the next one.